Biotech capital markets are broken. It's something we've been talking about for months and years with an index that's just been flat. Now, does that mean that over the last 5 years, we've made no progress? No, of course not. In that same time, we've seen 3 disease-modifying Alzheimer's drugs get approved. We've seen one of the largest therapeutic drug categories in obesity explode. And yet, from today to 5 years ago, the XBI is down 25%. What this tells us is that the XBI is not a good indicator for the sector. So the natural question is, what should our KPI be? For the S&P, we have an index that tells us about projected future earnings. It tells us what multiples should be ascribed based on the quality of the fundamentals, growth rates, margin profiles. It's an index that we can understand, that has actual meaning for where the companies within that index are performing. It gives a benchmark across the industries that it reflects. The XBI tells us none of that. If I were to go around and ask colleagues within the industry, what is the XBI telling us? Would I get consistent answers? My guess is no. The XBI really isn't indicating anything. It's just a basket of companies that trade, and we're happy when it goes up. We're frustrated when it goes down. We're not learning anything when it makes those moves. We don't know really why it's going up or down. We can't point to quantitative measures that are tracking fundamental progress across the industry. And that's a big problem. Isn't that table stakes for a good industry measure? If it doesn't provide a good diagnosis for fundamental progress, then how can we course correct? How can we take the intelligence of XBI going up or down? How can we take that and allocate capital differently? Or how can it change our behavior so that we can course correct, so that we can contribute to more healthy fundamentals? Right now, we're not getting that intelligence. And so we can't change our behavior. And so we can't correct course. It's a very big problem. Now, some might say, no, Matt, biotech stocks are also deriving their value from future earnings. But the trouble with that is the early stage nature of many companies within the index make it so that earnings 10 plus years down the road are really hard to discount back with good fidelity. And sure, while earnings still are relevant, we obviously need other value markers that stick much closer to the stage of relevance for the companies that it's meant to track, so that we can provide that good intelligence into why the sector is moving one way or another. For instance, how much health benefit is projected to flow to patients? We need other surrogate markers that can tell us our progress towards those types of indicators year over year, month over month, whatever. If we have a more efficient mechanism to measure health outcomes, biotech productivity year over year, and real value creation, then hopefully that allows us to allocate capital better. And hopefully that means that progress is rewarded with financial returns, as what should be the case in a functioning ecosystem. But with the XBI down over the last 5 years, we're not getting that right now within the current biotech capital markets infrastructure. Further, when biotech and pharma come into the crosshairs of public policy debate, which we are no strangers to, and even recently are facing, we can have clear answers. Should someone ask, what has pharma and biotech produced over the last year? Give me the data. What contributions year over year? What can you tell me? We'll have better answers. That's what we're trying to solve today. And there's a number of frameworks we want to put forward for our sector colleagues to review, to rip apart. We wanted to come up with just base structures to play with so we can solve this problem. But to us, it's the critical problem the sector has to solve, and we need to take an active role in shaping the future of biotech capital markets. We don't have to passively be whipsawed and without an explanation why. So with that, I'd like to get into what we'd like to cover for today, starting with the basic question, what is our industry KPI or KPIs? What are we using to tell us we're doing a good job? Number two, we want to frame the historical view of biotech capital markets to give us a sense of where have we been and where are we going. And finally, number three, where are we going is something that requires discussion because capital markets are evolving rapidly. And we want to pull some data into that could shape our perception of where we're going. So what do we have currently? If we're trying to figure out what our KPI should be, what are we using now? Well, we've talked about already the XBI performance, and we talked about why it's just not good enough. Each year in January, Union Square We're all talking about and trying to forecast what we think the sector will do. And we point to a lot of the same things. If I were to, ask 10 passersby with their little lanyards going to either the JP Morgan conference or, folks like myself that are not and are going to one of the other satellite conferences, we're all putting out the same topics, hoping that it moves the needle, hoping that it's a productive conversation. We're echoing a lot of what we hear. And, I'm not convinced it's actually delivering better outcomes for the sector. In reverse, if we were to ask those same 10 people, hey, last year, how did biotech do? I'd probably get 10 different answers. Some folks would tell me, well, we got X amount of drugs approved and that was good. It was more than the year prior. Okay. Well, this is what the M&A environment looked like. This is how many negative EV companies there are, and this is the trend. We'd hear things like that. But that's all we got. And it's just not sufficient. What we'd like is, again, metrics and measures that closely track to fundamental progress. 10 drugs approved, there's a wide dispersion of 10 drugs against 10 drugs, because we know there are potentially wildly different outcomes in terms of, what batch of 10 drugs you choose. Some that are going to be life-changing for millions of patients, and others that really aren't moving the needle and eventually just don't succeed commercially because the value isn't there. So we need to go under the hood a little bit further. And, I'll recall the S&P example again of a lot of the measures are a little bit closer to the stage of value where companies are. It's easier to understand. In biotech, we don't have that. We have phase 2 against phase 2, phase 2 Alzheimer's against phase 2 Alzheimer's. We don't have anything deeper across the whole sector to quantitatively measure company against company. So what could those benchmarks be? There should be room for us to create new quantitative measures so that we can return to San Francisco each year. And when someone says, how did biotech do last year? We have a really clear answer. We understand how productive the capital raised was in terms of how it advanced companies in their push to make good drugs for a lot of people. Or we know of the drug class that was approved last year, how did it compare year over year with prior years from an impact standpoint? We can have better answers. So that's what we took a stab at. And maybe not so well, but we wanted to do a first draft, if you will. And where we started was comparing drug class against drug class in terms of FDA class approvals. So we looked at the 2024 drugs that were approved by the FDA, and we went 10 years prior, and we compared that against the 2014 class of drugs that were approved by the FDA. And this exercise is not without precedent. A really nice analysis that the Boston Consulting Group did in 2015 was to look at, funny enough, they were looking at the 10 prior years, which is what we're doing. They were starting at 2014, going down to 2004. We're starting with 24, going down to 14. And they looked at, okay, year over year number of drugs approved, but potentially they saw the same pitfall that we did, which is how can we get impact for those drugs that were approved? And so not only did they track number of drugs approved, but they projected potential sales for each drug class, which makes sense. If you're an approved drug, you're closer to revenues and earnings. That data means more. And that is at least giving you a sense of how much value that's being created. So that makes sense. They also projected blockbusters from that drug class, Pembro sitting number 3, Harvoni sitting at number 1. And what's great about looking at 10-year-old projection data is that we can compare how they did. They did a really nice piece. They did a good job. Keytruda far underestimated. Who could have seen that coming? They also did not have the benefit of understanding how many supplemental approvals Keytruda would get, right? So their projections were really based, I believe, on just the initial indication that was approved. Keytruda has continued to be a drug that grows and grows and grows in terms of benefit to patients and in return, revenues to Merck. Harvoni, they were really good. They pretty much nailed peak year. They were estimating 2017. And so between the two drugs, cumulative sales have exceeded 150 billion. So a lot of value created from that 2014 drug class. And so this is really important to have these types of quantitative measures, because what we really would like to understand and the gaps we want to fill is how can we routinely compare drugs, drug outcomes, health benefits with financial returns? So we understand if any delta exists or not, but we need a recurrent way to measure health outcomes and financial performance for those underlying companies. And obviously there's a whole industry, insurance companies, health systems that are underwriting and really, tracking data and the financial overlay. But the industry as a whole, it's not routine in our analysis of the sector. And that's a missed opportunity, we believe. Number two, we need more measures above and beyond what BCG was doing. We need more measures because, as mentioned at the outset, we need markers of value closer to the stage where these companies live. They're living in the idea generation stage, in the product development stage, clinical testing stage. We need measures that are much closer to where they are. So the sales data that BCG was using is great when you're comparing drug class against drug class of approved drugs. Well, that's closer. That's a closer marker. Projected revenue is a closer marker to those companies. But for the companies that are in preclinical phase, it's really, really difficult to extract value from that type of analysis. So we took a stab at solving this. Here's an example of the quality of life scale we created. It's just illustrative. It's not optimized. We know that a number of different groups use these types of things. Again, we just wanted a framework to start experimenting with. It's arbitrary. From drugs that extend survival, they get the most amount of points, 5 points for each average year it extends above and beyond standard of care. If you're slowing eradicating disease by a year, 4 points. You see how we allocated points based on lessening of benefit conferred. Again, not optimized, plenty of room to make this better, but it's something for us to play with. And what we did was we took each drug in the 2014 class. We did the same for the 24 class. We have the approved indication for each drug. We pulled data from their label on efficacy benefits. We took into account the data that they generated to get their approvals. We estimated number of patients that could be impacted by that drug. And then we multiplied the number of patients by the QL value. So now we have a QL value for each drug, but then of course, we have the QL values for each drug and we can add those QL values across the whole drug class. So now when we're trying to compare year against year, it's not just how many drugs were approved, but we have a measure to try to estimate aggregate benefit across the drug, the complete class of drugs in that year of approvals. What this exercise told us and what the data tells us from this exercise, 24 to 2014, is that the 2014 class of approved drugs was higher impact in aggregate against the 24 class, which tracks quite well. I mean, there were some really significant drugs that were approved in 2014. I'm sure there's folks that have gone in the weeds, each year of drug approvals year over year and can weigh in and maybe likely give better insights. But for us, we have at least a clean measure. Imagine we do this year after year. Well, now we really know what each year of approved drugs are delivering. And the reason we need this is when we're thinking about our indices, the private markets, but in particular the public markets, we're not talking about 100 years of data. We're not talking about a mature ecosystem that can mean revert and we can predict well over time. We're talking about younger indices, right? Genentech going public in 1980. We've seen 4.5 decades of public markets. We're still nascent. It's not like 45 years isn't a decent amount of time. It is, but the makeup of the markets have changed so much over time. And we're still nascent from that perspective. And so what we also wanted to solve in this equation is a measure that can be used for companies that aren't at drug approval stage, but are much earlier. And we wanted to build a quantitative measure that can compare those companies company by company. So we're using the QL value that we've already defined. And for each company, we take the QL value, the projected QL value of their drug, the number of patients it could impact. We're looking at probabilities of technical success, commercial success. We're level setting that against how much capital is required to get to break even times interest rates at that time. And many of these measures are pretty self-explanatory. Estimated capital to break even, the QL value we defined. The probabilities of technical and commercial success need definition, so we defined them. And you'll see it's pretty straightforward. For technical success, we looked at things like target risk, modality risk, manufacturing risk. The more points, the better, because the more points, the higher probability of success. So for instance, things like target risk, if there's already commercial precedent for the drug, you're going to get more points. If there's already commercial precedent for the modality, you're going to get more points. If there's clinical precedent, you'll get 1 point less. So you'll see how we're rewarding points the less risk there's associated. On the commercial success side, we looked at key areas like competition, payers, prescribers, are incentives aligned? Is there a reimbursement code already that exists? If yes, okay, you get a point, higher probability. Prescribers, Do you require a paradigm change in order for prescribers to prescribe the drug? No? Okay. Higher probability of potential commercial success. So now we can apply this type of scale industry-wide, even to companies that are very far from an approved drug, and especially from potential revenues and earnings. So let's put this into practice and see what we get. Here are two illustrative companies, an Alzheimer's company and an oncology company. You'll see the commonalities and the differences. So commonalities, both have phase 2 data, both have reimbursement codes they can tap into, both have straightforward CMC, let's say both antibodies, right? Differences. The Alzheimer's company has efficacy data pointing to 1 year of disease delay over standard of care, compared to the oncology company, 3 months of progression-free survival over standard of care. 3 million applicable patients for the Alzheimer's company, 50,000 for the oncology company. So we see some commonalities, we see some differences. Let's put this into the BIR measure, the biotech investability ratio measure. Well, we have our QL values here. A 4 QL because you have 1 year of disease delay. 1.25 because you have 3 months of progression-free survival. We have here the number of patients being affected. We have the probabilities of success. You'll see in the assumptions, the Alzheimer's company, we estimated, needs 2 phase 3 drugs to get, phase 3 trials to get approved. We're probably undershooting estimated capital to get to break even, but this is the number we're using. The oncology company, we're assuming 1 phase 3 needed, and it'll be $250 million to get to break even. When we crunch the numbers, we see that the Alzheimer's company, on a relative basis, a much higher BIR, which makes sense. A lot more patients can be impacted, so it makes sense. Again, you can play with the numbers, and if we, for instance, were to say, no, the oncology company rather than 50,000 will impact and potentially benefit 500,000 patients, well, we're adding a factor of 10. The BIR will go up by a factor of 10. And so now we have a quantitative basis to compare company against company. And of course, financial markets operate such that fundamentals are then priced. And so now we can also use these BIRs to understand how is the underlying fundamentals of these companies being priced in the market. The Alzheimer's company, if we assume that it's trading at a $550 million enterprise value, it's getting a 600 times multiple on its BIR. The oncology company is carrying right now a $2 million EV. So right now it's trading at a 12.5 multiple on its BIR. Now we can hopefully get a better understanding of how fundamentals are stacking up company against company, but then also how are we pricing those fundamentals? And of course, we expect a lot of argument to take place in these, just as NVIDIA should get X multiple against AMD. We can argue those, this isn't meant to be a perfect system. But if it adds better quantitative rigor, we can have more productive conversations around how the fundamentals compare. We can have more productive conversations around multiples and richness evaluations based on fundamentals. And we have more quantitative teeth in those discussions. And imagine we apply these measures across the industry. Again, in biotech, we have a lot of folks that are very focused on their portfolios, subsectors they follow that they understand really well. But cross-sector, do we have good comparative metrics? Our argument has been no. Well, imagine we apply the QL values or the BIR values across companies. We can take, for instance, the XBI and apply the BIRs or the QLs across each company within the index. And now when we go back to Union Square each January and someone says, how did the XBI do? Or excuse me, how did the biotech sector do last year? Well, we can have a better answer. Did the portfolio, the holdings of the XBI incrementally improve from a BIR standpoint or not? Did it retrace? We can have an understanding of X amount of dollars were deployed into the XBI and the output was in some increase or maybe not, a retracement in BIR value. So we can measure capital investment efficiency relative to BIR. So we just have a much better understanding of, is capital being deployed efficiently? Are companies operating efficiently and actually making fundamental progress? And we're measuring the progress based on BIR, advancement or retracement, versus anecdotally saying, well, these 10 drugs got approved, these were good, or in the XBI, we saw these 3 data readouts, they were great. And anecdotally, that's nice information to have, but across all the constituents in the XBI, tell me how they all perform together from an R&D productivity standpoint. Can someone tell me that? Can we talk about that year over year and consistently? That information might exist. I hope it does. And I hope someone can educate me, but I don't hear it often. I hear about negative EV companies. I hear about conserve your cash. I hear a lot of anecdotal strategy of be efficient, get through clinical readouts, then raise money. I hear a lot of the same generic strategy advice, which is good, but I'm not hearing a lot of quantitative insight across the whole sector, year over year, month over month. How healthy is the sector? I don't know. That seems like a very big problem. If we want a healthily functioning capital market system, isn't it helpful to know how efficient capital is being deployed? Or how efficient is capital going into, companies, capital being raised, being deployed into companies, and how those companies are performing productivity-wise? Isn't that important? It's something we don't have or talk about. And isn't that a problem? So this is our proposal of something that might help add more insight. There's a lot of issues with this framework. For instance, in the BRRRR, there's a lot of factors. Well, the more factors you have, the harder it is to implement broadly, right? We also need to make sure we're not convinced that the ratio as it is now is optimized and is weighting the factors properly, right? The factors need to be weighted well for, need to be most closely defined or oriented to value creation. Right now, they're not. That can be optimized. We also need to make sure that we reduce redundancy, right? In the commercial probability of success metric, is that also pulling from the QL, is there redundancy between the commercial probability of success term as we have it defined and quality of life term? Is there redundancy there? We want to try to reduce that. So a lot of ways to improve these, and we welcome input, but we wanted some framework to start messing around with and experimenting with. But we have to do something, is our argument. We need to align incentives, and we need to add infrastructure into capital markets so that we can accelerate real value creation. If we don't find some other framework, then we'll just be continuing to talk about the same metrics that we already do. M&A is doing this. Negative EV companies are this. And we need to do it, this is imperative, before rates come down. We've talked quite a lot over the last many years, and we've heard quite a bit about how in 2020, 2021, there were too many companies that were funded that should not have been funded. And that might be true, but my follow-up to that is, how do we know? By what measure? Is that just a judgment call? Well, if the capital markets is informed purely by judgment calls, can that be efficient? So that might be right, but by what measure do we know that to be true? And we have to fix the dynamics of a system that's very anecdotal, judgment driven to more quantitatively driven, because should rates come down, hopefully, should rates come down, we can fix the incentives and measures that drive the ecosystem so that that doesn't happen again. If rates come down, capital flushes into risk assets. Do we see the same phenomenon happen again? And if so, aren't we culpable for not fixing what allowed the problem to happen previously? So that's why we believe that right now is imperative, because hopefully by the end of the year, we see visibility into a sustained declining interest rate environment, maybe, hopefully. And what we hope that means is capital flowing in. We want it to flow in efficiently. That's what we all want, right? Well, we have to take an active role into helping that happen. What we're weary of is an attitude that tourists or folks that aren't strong bio people, tried and true bio people, we're very weary of an environment and a capital markets ecosystem that does not welcome those dollars. If the biotech capital markets are only open to MDs, PhDs, how can it be an efficient ecosystem? Don't we want more participants? In the last many years, we've had a lot of MDs, PhDs operating within capital markets. It's not done well. Don't we want as many participants as possible? I understand that we're weary of folks throwing money at anything. I get that. That's a legitimate concern. Again, it harkens back to the concern of in 2020 and 2021, too much money going to fund too many companies that shouldn't be funded. I get that concern. But we need to take an active role in preventing it from happening. And the only way we can do that is to build better infrastructure and guardrails. Our argument is that more quantitative measures governing the ecosystem are those guardrails. And why do we expect more and more capital to potentially be available to flow into the ecosystem? It may not, but why do we expect that more capital can be available? Because we're seeing a shift in the economy from lower agency roles and behaviors, Americans, that is, flipping to wanting higher agency roles, hobbies, activities. That's a shift and a trend that we will continue to see, is our argument. We see it in terms of the jobs that individuals take on. The US economy continues to grow more and more into a service-oriented economy. And we've seen in the last decade an explosion of high agency type of activities, a creator economy, a gig economy, freelancers, side hustle real estate investors, and importantly, retail trading. Folks wanting to take their destiny into their own hands. But folks want to allocate capital confidently. We saw this isn't a passing trend. Pre-COVID, from pre-COVID to beyond, there was a doubling of retail participation in the public markets. That didn't spike and draw back. It has persisted. We expect that to continue. And our argument is that the biotech capital markets should welcome that flow of investment dollars. But it can only absorb that capital flow if the infrastructure is built to withstand it. Right now, in biotech, financial performance is not really following. I don't even know, actually. I was going to say it's not really following fundamental progress, but I don't know. That's part of our argument, I guess. I don't know if that's true because I don't know industry-wide productivity and progress from the sector. So we don't really know. I don't anyway. So one, that has to be fixed. But number two, if we can build more predictability into progress, reading through to performance, that is what gives folks confidence to invest. If you don't know if financial reward will follow fundamental progress, why would you invest? And again, without the infrastructure that can tell us that with high fidelity, well, we're sitting at 2000 Dubai, right? The city of Dubai from the year 2000 to today is drastically different. The roads were laid, the infrastructure was built to absorb those visitors. Our argument is that the biotech capital markets should do the same. And we should actively lay the tracks, build the guardrails, build the quantitative measures that can help build more predictability into financial reward following fundamental progress, giving folks confidence to come in and invest. And then that helps us avoid the ills of the past of companies not getting funded that shouldn't get funded, if that is in fact what happened. If folks can understand quantitatively why company A is well below industry standard against company B quantitatively, well, less dollars will flow there. So the infrastructure has to be built, but we should want to welcome those dollars. There is precedent for this, boiling complicated subjects down to simple measures. We'll use a silly example, but a relevant one. Pro Football Focus and their passer rating. Let's take a bunch of different data points, boil it down into one measure, passer rating. Let's compare Josh Allen, Jared Goff. Let's give folks who aren't football experts some way to compare relative performance. And it can be wrong. There's going to be argument in the data, right? People can take a point of view that is contrarian. So this isn't meant to be perfect, but it's some basis to understand and compare assets. Whether they're people, the assets are people on a football field, or the assets are drugs in a pipeline of a company. But we can compare better across a whole sector. And not just, you know your portfolio, I know my portfolio. But we can compare across an entire industry. We can welcome others to participate, to poke at assumptions, to determine who deserves a premium valuation versus not based on their quantitative measures, how they stack up. But right now, there's very little tracks laid on the ground. And even with, again, a lot of fundamental progress in the last 5 years, predictability of financial performance is very thin. And absolute performance is well down. Thank you for making it this far and hearing us out. To summarize, we made what we hope were 3 clear points, which were namely this. Number one, the biotech industry as a whole does not have a good set of measures to track sector performance as a whole. We track individual companies quite closely. As a sector, we do not. For example, can anyone tell me on average, as a data point, as one composite data point, how all the companies within the XBI did in advancing their programs. If we were to add, for instance, all the phase 1, 2, 3 successes, minus all of those failures, and we can track period over period what that performance looked like. I don't think we have that. Now imagine if you took a step further and looked at that composite point, but multiplied the health impact for each of those phase 1 successes, phase 2 successes, phase 3 successes, times their health impact. And we had that as a measure, minus all the failures, and we had that as a measure to track performance period over period. That would be even that much better. We just don't have that. We have a lot of anecdotes, but for a bunch of scientists, we seem satisfied with governing our sector with stories. Number 2, biotech capital markets are still too immature to think that we can just snap out of this soon. That's not happening. There is a deeper issue here. This isn't a cycle. We have structural problems that are either partly or wholly attributable to the first point we've been really focused on. So this is not a this too shall pass moment. This is a there's a crack in the foundation moment. We're not mean reverting, and we need to fix the structural issues. Point number 3 was that finally, over the next several decades, there will be a lot of self-directed capital flowing into risk assets. And even this year, we're already seeing it happen. Look at crypto, look at Palantir's stock. You know where it's not flowing as heavily? Biotech. And why? There's a very poor linkage between fundamental progress and financial reward. The risk reward is out of balance for our sector, even when you take out the tourists who clearly have not been present for the last year or two. We do want those dollars, the self-directed dollars, the high net worth, the retail, we want those dollars flowing into this sector. But it only will if we fix the foundation and actively shape the quantitative infrastructure that can connect company outcomes and company performance to financial performance. Right now, there's a very weak correlation, which means less confidence in making investments, which mean the investments don't happen. There are so many smart people in our ecosystem that have a lot of experience. We really would welcome your thoughts, your criticisms, your ideas. There's a lot of flaws, there's a lot of mistakes I'm sure we made, and we welcome your corrections. We'd be ready to roll up our sleeves and work with anyone that would have the willingness to work with us. So please reach out with any feedback. Thank you for your time to hear our thoughts.